The European Central Bank has embarked on a series of interest rate cuts to stimulate economic growth within the Eurozone. This strategy began in June 2024 and continued in the following months. As of January 2025, the ECB has implemented another rate cut. Economists predict more cuts by mid-2025. This could bring the terminal rate down to 1.5%. The ECB's aggressive approach reflects concerns about the Eurozone's economic health. However, this strategy is not without its critics. Some argue that the ECB's rate cuts could lead to unintended consequences. They point to potential asset bubbles and financial instability. Despite these concerns, the ECB remains focused on price stability and economic growth. The rate cuts are seen as necessary to achieve these objectives. The coming months will reveal whether this approach will be successful. Germany, the Eurozone's largest economy, is undergoing a significant fiscal policy shift. The country is increasing spending to stimulate economic growth. This expansionary fiscal policy stands in contrast to Germany's traditionally conservative approach to public finances. The increased spending targets key areas, including infrastructure, green energy, and digital transformation. These investments are intended to modernize the German economy and boost its long-term growth potential. This shift in German fiscal policy has important implications for the ECB's monetary policy. Some economists believe that Germany's increased spending could lessen the need for aggressive rate cuts by the ECB. The logic is that fiscal stimulus will provide its own boost to economic activity, reducing the pressure on the ECB to act alone. However, the outcome of the German election on February 23, 2025, will be crucial. The election results could impact the future direction of fiscal policy. A change in government could lead to a reassessment of spending plans, potentially altering the interplay between German fiscal policy and ECB monetary policy. The euro, the common currency of the Eurozone, faces a delicate balancing act. On one hand, the ECB's rate cuts tend to weaken the euro, as lower interest rates make the euro less attractive to foreign investors seeking higher returns. On the other hand, Germany's fiscal expansion could potentially strengthen the euro. Increased government spending can lead to higher economic growth, which in turn can make a currency more attractive to investors. The interplay of these two forces creates uncertainty for the euro's future direction. Some analysts believe that the euro could weaken further if the ECB continues its aggressive rate cuts. Others argue that Germany's fiscal expansion will provide support for the euro, potentially offsetting the impact of lower interest rates. The euro's exchange rate is crucial for businesses and consumers across the eurozone. A weaker euro makes exports more competitive but can also lead to higher inflation, as imported goods become more expensive. A stronger euro has the opposite effect, potentially dampening exports, but also keeping inflation in check. The coming months will reveal how these competing forces will ultimately shape the euro's trajectory. Market participants are closely watching the ECB's policy decisions and Germany's fiscal measures. Traders are trying to anticipate future monetary and fiscal policy, leading to diverse market bets and uncertainty. The ECB has signaled rate cuts, but the pace and magnitude remain unclear. This lack of clarity makes it difficult for traders to price assets, leading to market volatility. Adding to the complexity is Germany's evolving fiscal landscape and upcoming elections. The interplay between monetary and fiscal policy is complex, and traders are struggling to assess the impact on the Eurozone economy. This uncertainty is reflected in the wide range of forecasts and analyses being presented by market commentators. The ECB's policy decisions are not made in a vacuum. The central bank must carefully consider a range of factors including inflation, economic growth, and global economic conditions when determining the appropriate course of action. Inflation within the Eurozone has been relatively subdued in recent months. However, there are signs that inflationary pressures could be building. Energy prices have been volatile, and there are concerns that rising energy costs could feed through into broader price increases. Furthermore, the Eurozone economy faces a number of headwinds. Global trade tensions, particularly US trade restrictions, pose significant risks to the Eurozone's export-oriented economy. Additionally, despite falling ECB policy rates, Eurozone bond yields have risen, potentially acting as a drag on economic growth. the ECB must weigh these factors carefully when deciding on future interest rate policy. The central bank's mandate is to maintain price stability while supporting economic growth. Achieving this balance is a delicate task, particularly in the current environment of uncertainty and potential risks. As of January 2025, prior to the latest rate cut, the ECB's key interest rate stood as follows. The deposit facility rate was 3%, the main refinancing rate was 3.15%, and the marginal lending facility was 3.4%. These rates are subject to change at the ECB's upcoming monetary policy meetings. The ECB's Governing Council meets 8 times a year to assess economic conditions and make decisions on monetary policy, including interest rates. The ECB's 2025 meeting dates are as follows: January 30th, which has already passed, March 6th, April 17th, June 5th, July 24th, September 11th, October 30th, and December 18th. Traders and market participants will be closely watching these meetings for any announcements regarding interest rate changes or other policy adjustments. The ECB's communication and policy decisions will be crucial in shaping market expectations and influencing the direction of the Eurozone economy. The Eurozone economy stands at a crossroads. The ECB's rate cuts, intended to stimulate growth, are interacting with Germany's expansionary fiscal policy in complex ways. The euro's value hangs in the balance, subject to the push and pull of these opposing forces. Market uncertainty reigns supreme as traders attempt to decipher the ECB's next move. Inflationary pressures, global economic headwinds, and domestic political considerations all factor into the central bank's decision-making process. The coming months will be crucial for the Eurozone. The ECB's monetary policy decisions, the outcome of the German elections, and the evolution of the global economic landscape will all play a role in shaping the region's economic trajectory.